reason Bitcoin has historically rallied during geopolitical conflict, and the specific reason, from my view, it's rallied during Iran, is that two things have happened to that out of the money call option.
Hougan begins with a straightforward but powerful framework. Bitcoin's valuation is tied to the growth of the store of value market and its ability to capture a larger share of that market. Today, the global store of value market, comprising assets like gold, real estate, and other wealth preserving instruments, is estimated at around $38 trillion. What's striking is that this market has grown consistently at approximately 12.5% annually over the past 2 decades. To illustrate this, Hougan points to the transformation of gold. When the gold ETF launched in the early 2000s, the total gold market was about $2.5 trillion. Today, it has ballooned to roughly $36 trillion. This historical precedent matters because it shows that store of value markets expand dramatically over time. If that trend continues and Bitcoin continues to gain adoption, the math becomes compelling. A decade ago, Bitcoin represented just 0.1% of this market. Today, it holds around 5 to 6%. If Bitcoin grows to capture approximately 17% of the expanding market, Hougan argues, it naturally leads to a valuation in the $1 million range. No speculation required, just growth plus market share.
Yeah, sure. So for Bitcoin specifically, our target, yeah, it's $1 million or 1.3 million by 2035. The key drivers on that are growth of the addressable market that Bitcoin serves, which is the store of value market, which today is like a $38 trillion market. The interesting thing about that market is it's been growing at a TAM of 12.5% per year for the last 20 years. You probably remember when the gold ETF launched. I certainly do. The entire gold market was $2.5 trillion. Today it's $36 trillion. So there's been enormous growth in that market. So one of that preconditions is just that growth continues. The other is that Bitcoin continues to steal market share as it has. It's gone from about 0.1% market share 10 years ago to 5 or 6%. We think if it gets to 17% and the market continues to grow, you get to $1 million. You can use that same sort of analysis to estimate sort of value accrual in the programmable L1 space. You need the total addressable market of assets on chain to grow. Right now, it's really vertical, right? Enormous growth. I think everyone considers that moving to grow. And then you need to find the L1s that are capturing the market. Of course, there are other things. You need regulatory progress, you need continued education, but those are almost fait accompli. What you really need is the addressable market to grow and then market share to sort itself out. And from there, it's honestly just math. And that's how you get to those price targets. Yeah, that's the funny part. I just said why it'd be a million, and actually that piece points to it being multiple millions, which I think is true. I've always described Bitcoin as a store of value with an out of the money call option on being an international currency. Out of the money because for most of Bitcoin's existence, that idea seemed far-fetched. We were in a dollar only world. All financial transactions were settled on dollars. The idea that we would move to this novel cryptocurrency to settle major international transactions just seemed unlikely. The reason Bitcoin has historically rallied during geopolitical conflict, and the specific reason, from my view, it's rallied during Iran, is that two things have happened to that out of the money call option. One, just by the nature of geopolitical conflict, it raises the volatility of the global monetary order, right? We've fractured from dollar only to dollar yuan. You're seeing in Iran, people are considering other solutions. When you raise the volatility of an option, it raises its value. The other thing that's happened is we saw Iran propose tolling the Straits of Hormuz and settling in Bitcoin specifically, which raises the probability that long term we will need an apolitical currency to settle transactions between parties that are distinct. The really interesting thing to me is that you still have this store of value thesis intact, which we just talked about, I think takes Bitcoin to $1 million. If you start to have Bitcoin be not just a store of value, but actually a currency, sort of two use cases, two bets at once, I think you're talking about multiple millions of dollars. And what we're seeing in Iran is raising the volatility of that possibility and also increasing the probability of that, getting closer to the money. That's why Bitcoin's up. I think that it keeps going up from here. I think it's a really good setup for Bitcoin. I think it's going to be different because you have these two real fundamental narratives. You have Bitcoin as money, and you have the stablecoin and tokenization push. When I go speak to the largest institutions in the world 2 or 3 years ago, it was really about quote unquote crypto. And we would mostly focus on Bitcoin because that was the easiest thing for them to understand. Now, if I go speak to an endowment or a family office or a financial advisor, half the conversation is about Bitcoin, half the conversation is about how to play the incredible growth in stablecoins and tokenized real world assets. And so I think what we're going to see is both of those boats rising at once. They are supportive to one another, though. People miss this. Even though they're different use cases, when somebody onboards into the Bitcoin ecosystem, they're proximate to this other ecosystem. And we see people go into Bitcoin and then diversify out to capture the broader opportunity in crypto. The same thing is true in reverse. If people are excited about the growth of tokenized real world assets, and they may allocate to BAVA or ETH or other ETFs, they also eventually add into Bitcoin. So they do rise at the same time. I don't think it's going to be Bitcoin leading necessarily. I think it's going to be two boats moving in, not quite in tandem, but sort of dragging each other upward and to the right. Oh, yeah. Well, I think it's happening. I've said this before on podcasts, but the average Bitwise client, it's brutal for our business, but maybe good for crypto. The average Bitwise client allocates after 8 meetings, um, which means that we have to go out and educate people 8 different times before they start to invest. If you think about meeting with financial advisors, you're lucky if you meet with them quarterly. The reason that's relevant is if we started meeting with them when the Bitcoin ETF launched, we're just getting to meeting 8 now. And actually, Bitwise had its best quarter ever in Q1, despite prices being down in terms of the impact of those meetings. I think we've really started to reach the inflection point. The initial flows we saw into ETFs for the first 2 years were people who were ready to allocate before the Bitcoin ETF launched. They were pro crypto, they were crypto native, they were crypto friendly, they were probably allocating on their own individually. They were ready to allocate, they were just waiting for the ETF. The people who have been studying crypto since the ETF launched, they're just now starting to allocate. And that's only for RIAs, which are independent registered investment advisors. When you move into firms like Morgan Stanley or other firms in that space, they've recently greenlit crypto, and so they're starting to move up that curve. I think what you're going to see is this series of waves of capital moving into crypto over time. That's just going to increase. I do think you're going to start to feel it in the prices, feel it in the market infrastructure, feel it in compressed volatility because these flows are much less price dependent than retail specific flows. Right now, actually, we're at that magic 2 year, 8 meeting threshold. And I think you're going to start to see it as in the second half of this year.
One of Hougan's most important insights is that the future of crypto isn't a single narrative, it's dual track growth. On one side, you have Bitcoin as money. On the other, you have the rapid rise of stablecoins and tokenized real world assets. These include everything from equities to real estate being represented on blockchain networks. Unlike in the past, institutional conversations are no longer just about Bitcoin. According to Hougan, discussions with financial advisors, endowments, and family offices are now split roughly 50-50 between Bitcoin and broader crypto innovations. This shift signals maturity. Crypto is no longer a niche asset class, it's becoming an ecosystem. Importantly, these two narratives reinforce each other. Investors entering through Bitcoin often expand into other crypto opportunities, while those drawn in by tokenization eventually allocate to Bitcoin. Rather than competing, these sectors create a feedback loop of adoption.
Yeah. The funny thing about being a CIO in crypto is, all the friends you tell to buy Bitcoin and they buy it or crypto at the bottom and it does well, it was all their decisions and they deserve the credit. And then if they happen to buy at the top and it pulls back, they blame you. So those are the calls. Those are the calls you get. Look, I mean, people call and ask me basically, what are you doing in your personal portfolio? That's actually what people want to know. What are you doing in the personal portfolio? The terrible thing about me is my personal portfolio is deadly boring. I just buy crypto and then I buy more crypto periodically. That's what I do. I don't time the market actually. I just sort of steadily hold Bitcoin and other crypto assets almost in a market cap weighted fashion. I have exposure to Avalanche, I have exposure to ETH, I have exposure to Bitcoin. And so they're always disappointing. They're like, are you selling? No. Are you buying? I don't know. Is it the end of the quarter? Unfortunately, I have a very boring approach to actually investing. I actually don't think you can put the genie back in the bottle from a global financial system, how it works. So we've raised the probability that the world is moving to a multi currency settlement world. That started happening with the Russia Ukraine war. It accelerated in this war, and we saw Bitcoin for the first time sort of edge up to the table and get a seat at the table. I don't think that reverses. I don't think we snap our fingers and everyone goes back to the SWIFT system and has full faith and confidence that the US won't use that to apply sanctions, restrict people, etc. I think sort of what this has done is cracked the facade, and countries around the world realize they need an apolitical alternative that is not sort of dictated by any one country. So I look, I'm hopeful, of course, like everyone, that we get to a peaceful and high quality settlement, and conflict ceases. But I don't think you put the sort of dollar only, Swift only world back together. I think once that confidence is fractured, once Bitcoin gets a seat at the table, I don't think that reverses. I think it only goes in one direction. So, look, I actually think the market would be. It sounds a little Pollyanna, like I'm saying it was good for Bitcoin that there was the conflict, and it will be good for Bitcoin when the conflict ends. That on the surface doesn't make but I think it's actually true. It was good in that it happened, in that it raised the probability of Bitcoin getting a seat at this table. And then the removal of sort of the risk concern will also be positive for risk assets. So I do think this is actually a Bitcoin wins twice sort of scenario. Well, like everyone through the crypto markets. I mean, crypto has become the 24/7 365 rail, right? How did we know how oil was going to respond during the initial wave of the crisis? We looked at hyperliquid. I do think the answer is you monitor it from a price impact perspective using decentralized global crypto markets. I think it's the most responsive instrument to that. From a news flow cycle, obviously it's exhausting, and you have to think about it constantly. Crypto never sleeps, but I do think that's another glass that can't be unbroken actually from this conflict, is the idea that the world now needs to be 24/7 365 from a trading perspective. I don't think if you're a macro hedge fund and you experience the last 6 weeks that you can possibly say, I don't need the ability to access these global crypto markets and be able to respond to market events that tend to happen on nights and weekends when the global traditional markets are closed. I think that was another thing that was sort of changed in this conflict that will never go back the other way, right? We're now 24/7, and you have to be. So, to answer your question, I watch crypto prices and then read all the news flow and monitor it on X. Um, but I do think an important thing has changed in how people perceive the market, which is it's 24/7, it's global, and you need to be able to respond to that. It really comes down to portfolio impact. So a retail investor will want to get excited about the outlook for Bitcoin, get excited about the outlook for Avalanche, get excited about real world assets. They want to talk about this use case, that use case. Institutions do that as well, but then they transition into, how do I actually build a portfolio? What size do I rebalance? Which assets? How do I weight them? What is the market portfolio? As you know, John, a lot of institutional investors just want to start by being at the market level, right? They want to make sure that they're exposed to the benchmark. And for what it's worth, that doesn't mean 0% crypto. Crypto is a $2 trillion market. Equities are a $110 trillion market. So their starting point is like 1.9% crypto. And then they need to decide, should I over allocate or under allocate? It's really about that portfolio execution piece that separates the institutional discussions from the retail discussion. I would say one more thing. I think generally speaking, institutions have a much longer view. A funny thing about this market pullback is that no institution really cared. The people who had invested understood that crypto was volatile. They weren't surprised that it pulled back. They were looking to add more. The people who hadn't invested saw this as an opportunity. I think retail is more generally short term focused. Institutions are investing for 3, 5, 10 years. And so maybe they're less impacted by the psychology of crypto's volatility as well.
Matt Hougan's perspective offers a rare blend of clarity and conviction in a space often dominated by speculation. His $1 million Bitcoin thesis isn't built on hype, it's rooted in measurable trends, the expansion of the store of value market, and Bitcoin's growing share within it. But what truly elevates his argument is the second layer, the possibility of Bitcoin evolving into a global apolitical currency. Combined with the parallel growth of tokenization and institutional adoption, this creates a powerful, multidimensional growth story. We are witnessing the early stages of a transformation in how value is stored, transferred, and understood. From slow-moving institutional adoption to the rise of 24/7 financial markets, the foundations of the global system are shifting. Whether Bitcoin ultimately reaches 1 million or beyond, one thing is clear. It is no longer a fringe experiment. It is becoming a central pillar in the future of finance. And if Hougan is right, we're not late. We're just getting started.